All right, as we march towards the opening bells, we wanted to talk a little bit more about how Canada's stock market has fared versus the U.S. this year. And you've probably heard this story many times. The outperformance of several technology stocks, the so-called Magnificent Seven stateside, has helped the S&P to far outperform our benchmark in Canada. The numbers are as follows. The S&P up close to 20% in 2023, roughly 4 times the overall return for the TSX. Now, again, you could say, well, hold on a second, there's only a handful of stocks that have outperformed. But when you look at the TSX itself this year, the key influential groups, the financials, the energy, material sectors, they've all underperformed the overall TSX. Again, you could go back to, okay, well, tech stocks in Canada have done better. That is true. But even looking at an equal weighted version of the S&P 500, those 3 sectors have lagged the U.S. So what does 2024 hold? We're back now with John Goldsmith. He's head of Canadian Equities at Montrusco Bolton. John, when you hear those numbers, what do you think?
Yeah, I think a little bit of context is important here. So, U.S. market typically has a tendency to outperform Canada. U.S. has had a great run over the last 10 to 15 years. And if you actually take a look at the U.S. percentage of the global benchmark, Canada's maybe not even 3%. U.S. is now close to 70% of the global benchmark. And you go back 10 years ago, that was in the low 50s. Talked about the Magnificent Seven. Magnificent Seven today, 29% of the benchmark. Go back 10 years ago, not even 10. And if you take a look at the top 10 of the U.S. market, 33%, I go back 10 years ago, and once again, it's because of the Magnificent Seven, that was sub 20%. So the Canadian market over the last 5 years, so call it dial it back a year or so before COVID, is actually the second best performing large regional market. Like the U.S. has crushed it 90+%. Canada over that time is up over 60. And if I take a look at like the European market in and of itself, Australian market, that's mid-50s, Japan, mid-30s in terms of total return. Canada's actually performed pretty well, even though it's a market where you've got higher concentration in 3 core sectors.
So should we just eliminate the U.S. for a second and just ask the question, if you're putting money to work in the Canadian stock market, if that is a good return on investment proposition?
For 2024, I think so. And the reason why, like earlier we were talking about interest rates, likelihood is that you will have a decline in rates. And one of the headwinds for Canada is Canada's got a higher dividend yield than the U.S. has. And as a result, more dividend stocks. Dividend stocks didn't perform all too well this year, just as long duration bonds didn't perform all too well in the face of the headwinds of longer rates or higher rates. Well, guess what?
Yields kept going up. That's attractive to investors, maybe sucks away some of the attention.
Exactly. You're going to have some reinvestment risk with that as well, because it's great to get a 3-month GIC at 5%, but in 6 months' time, if that rates are down to 1.5%, then it's not all too great. Whereas you can buy dividend stocks that are growing 5 to 10%. That's a pretty good inflation hedge, a heck of a lot better than what you'd get on a front-end GIC. Point is, however, dividend yields as well as the overall tech stocks, those are actually going to be a beneficial impact next year with rates going up. Canada doesn't have a really big exposure to the discretionary segment, so you're thinking of names like, BRP, Bombardier recreational products, Cineplex next year. You might have a little bit of headwinds on that front, but energy transition is most likely going to be positive news for Canada. Declining rates is going to be positive for dividend yielding stocks. All in all, looks like probably a pretty rosy market for Canada next year. Once again, the big caveat is not having some major type of recession. And we don't think Canada is going to enter a recession. We think it's just going to slow down.
Is there one particular group of dividend-friendly names that appeal to you more than others?
Yeah, it probably, so once again, you get the double benefit with the energy names. So not only are you getting high dividend yields with a lot of those names, CNQ, Tourmaline, both of those names we own in the portfolio, yielding over 4%. But more importantly is you're going to get the benefit also potentially of higher energy prices. And that's on the back of most likely a declining U.S. dollar. Declining U.S. dollar is usually good for commodities. Canadian market, you look at the large cap, it's almost 30% of the benchmark, and small cap, it's almost 50% of the benchmark. Declining USD is going to be good for resource names, especially the dividend yielding resource names.
Just a really long-term question here, going back to those Magnificent Seven. You've got Tesla in there, you've got Apple, you've got Microsoft, which has reinvented itself, NVIDIA, all these companies that seem to be at the center of how the world will continue to change over the next decade. Can investors afford to shift away from that group because they've had a big run versus other sectors?
I don't think it's a question of an all or nothing bet. It's a question of diversifying your portfolio. So just as the US has gone from roughly 50% of the world's market cap to 70%, you use these opportunities to perhaps cull your portfolio, take some money off the table. They are already trading at higher multiples, and the resulting higher multiples due to the higher growth, which is great. But once again, the question is the ability to continually be able to reinvent themselves. Apple 10 years ago had been around for 10 years prior to that, and they had reinvented themselves. Difference is today, the Mag 7 is almost 30% of the US. 10 years ago, they were 10%.
Yeah, those are helpful